Africa at an organization called Convergence. We are the Global Center for Excellence for Blended Finance. And I will be taking you through this Blended Finance Masterclass for the next 2.5 to 3 hours. And I'm joined by?
Morning, everyone. I'm Palesa Mkhize, and I come from an amazing country called South Africa. I will be covering the second half of the masterclass after AUHF. I currently am the CEO of an organization called the South African Multifamily Residential Rental Association. I know it's a mouthful, but formerly I headed up affordable housing at Standard Bank in South Africa. And I am one of the co-authors of the report that will feature largely in our session today. I don't know if you've been given the QR codes for downloading the report itself, but we're going to go through some case studies which are featured in the Blended Finance for Affordable Housing report. But let me not run ahead and let AUHF take over.
So the reason why you have, I guess, two presenters, two facilitators, is Palesa is a housing expert. But I'm coming at this topic very much from finance, financial structuring. I'm not a housing expert. I worked across infrastructure, energy, agri, SME finance, banking. But Palesa's the housing person, I'm the finance person, and our job today is to bring these two concepts together. That's really the idea. I'm very curious to know what you all are looking to get out of this next 2.5, 3 hours. So why are you all here? Is it because you wanted to come to Nairobi one extra day and attend the masterclass, or is there any other purpose for you to be here? So maybe a show of hands. Like, what are you looking to get out of this? What are you looking to learn?
Actually, how the blended finance for affordable housing could work in my country, in fragile and highly conflict area, where the country relying on donor funding, and how this can cope with the situation in Somalia, with the practical examples.
Thank you. Anybody else? Catherine?
Hi, good morning. I think it would be interesting to see how we can use blended finance to make affordable housing finance more developmental. So instead of just financing the top structure or the unit or whatever, how to finance, expand it to finance more complex environments surrounding the development.
So I'm Lisa from Ghana. And the blended finance is sort of a new concept in Ghana. So I'm here, I'm interested in how it works. And my company, Vadi Prime, we are developers and we are also interested in affordable housing. So both concepts are very important to us. They have much interest to us. So thank you.
Great, yes.
Hi, I'm Richard from South Africa, although I do mostly business in Zimbabwe. And like you, I have a broad banking background. I've been out of housing for about a decade, but I used to be at Standard Bank and used to do the real estate business. In fact, I founded Ghana Home Loans, so I have a fondness for Ghana. The challenge we had decades ago, and I don't know if it's really changed, was very limited capital markets in African countries, particularly local currency. So in Zimbabwe, I'm focusing because I can actually lend in dollars and borrow in dollars, because we all know what happened to the Zim dollar. It doesn't exist anymore. That'll change one day. But in countries that have got capital markets, I'm sitting here in Kenya, you just don't have a long-dated bond market. Kenyan shillings are volatile. So, I mean, respectfully, you're not going to get a scale on housing finance. You're not going to get scale in property development unless you've got long-term mortgage finance. And so I'm hoping that blended finance, there may be some tricks, and I'm looking to learn from the experts. Thanks.
Last.
Thank you. My name is Jumoke Akimomi from Lagos, Nigeria. I'm here, first of all, as a beneficiary of a grant from Convergence, looking at a product that is meant to address the intersect of gender and housing and enterprise, particularly around women. And actually for most of us in Africa, I think the hugest challenge has been the lack of depth for financing products. And so just the ability to understand that there are funders out here with a different, with different needs and different requirements that we can tap into is of interest to me. Thank you.
Great. So the idea for this session is, I recognize that not everybody is familiar with the concept of blended finance. Not everyone comes from a banking background. So the idea for this session is to make sure that as we build on these conversations for the next couple of days, to make sure everyone has the same foundation. And so my objective from this session is to make sure that all of us leave with a sound understanding of blended finance. What is it? What it isn't? What are the various instruments that are used to blend? When do you use one instrument versus the other? What are some examples? And then Palesa will really take some of that and layer that on with a background from a housing perspective. So the first part will be a little bit more about blended finance more broadly, and then the second part will be blended finance and the intersection of that with housing. Does that sound okay? Reasonable? Good? Okay, great. Why do we need blended finance in the first place? We'll talk about what blended finance is, but why do we need blended finance in the first place? Ideally, all of this should be working on purely commercial terms. We should have commercial transactions. We shouldn't be needing philanthropic money or donor money or concessional money from the development finance institutions to blend. But what are some of the challenges, and why do we need to blend?
I don't really know, but I have a guess. It's to reduce risk and to diversify the capital income in terms of the resources.
Yeah, that's one of the reasons, yeah. Anybody else? Yes. So reduce cost of capital? Yeah, okay. Anybody else? Oh, I could ask you the question, why is the cost of capital so high in the first place?
I guess, like what said, that probably don't have enough financial markets.
Mm-hmm.
That allow us to get affordable property, but also at the same time tenure, which also affects.
Let me start here as well. What is blended finance? So you all attending a blended finance masterclass. Presumably, some of you at least have Googled this on your way in. Some of you Googled this last night. Some of you already know what blended finance is. Seema, I'm sure you know blended finances because you work at FSD. But for the uninitiated, what is blended finance, in your opinion? It's okay, we're just a safe room. Don't worry, don't be afraid. Yes, I'll give it to her.
I think it's when you blend or mix commercial money, which obviously comes usually at commercial rates, with subsidies, say, from government, with impact funding from DFIs and other impact investors, so that the overall weighted cost of capital can be hopefully cheaper to reflect the impact as well as the commercial benefits that are given by that project.
That's great. So essentially, it's the use of development funding from donors, from DFIs, from foundations, on non-market terms or concessional terms, with the express intent and purpose of mobilizing that private capital that's sitting on the sidelines on market terms into these structures, into the sector that we all are interested in, right? And the question that we need to ask ourselves is why is that private capital sitting on the sidelines and not invested in the first place? And that's something that we want to unpack as well over the next few hours. What is the difference? This is very important. What is the difference between blended finance and public-private partnerships? Because oftentimes, people conflate the two. I've always heard people use blended finance and PPPs interchangeably. So what is the difference between blended finance and a public-private partnership? Anybody? So let me maybe simplify that a little bit. So both of you are right in some ways. I'm just going to maybe simplify it again. The way I think about blended finance is it is a financial structuring approach, right? Nothing more, nothing less. PPPs are a contracting approach. You may or may not have concessionality embedded within the contract. So you've got to look at the terms and conditions and see if there's a concessionality embedded within the contract. So one is a structuring approach, one is a contracting approach, may or may not be blended. That's depending on the terms and conditions, right? Just to simplify. There's another term that everyone uses and again conflates. It's called impact investing. Impact investing is nothing more or nothing less than a investment approach. I am putting capital to work with the expressed intent of achieving development impact. Not all blended finance transactions have impact investors within them. You could have a foundation, a DFI, and an institutional investor, and no impact investor. So impact investing is an investment approach. Blended finance is a structuring approach, and PPPs are a contracting approach. Is that clear? Is that a good foundation to start with? Okay, great. Now, oftentimes when I travel to meet investors, institutional investors, pension funds, insurance companies, sovereign wealth funds, and I tell them, have you thought about investing in Africa, infrastructure, SME financing? They often tell me, all this is great, but my biggest constraint is regulation. How many countries in Africa have an investment grade rating? Who said that? 5. You're very optimistic. I like it. 2. Botswana and Mauritius. And Botswana might lose its investment grade rating the way it's going at the moment, unfortunately. So this is a big, big problem for all of us, right? If I'm looking to mobilize pension capital or insurance capital within the continent from on a cross-border basis, I have a challenge. I have a sovereign ceiling that I'm working with, and we need to think about how do you create products that meet this criteria that investors have. So when I speak to Allianz Global Investors or MUFG or Zurich Insurance or the Canadian Pension Plan Investment Board, everyone says, housing sounds interesting. Infrastructure in Africa sounds interesting. Give me product that A, I understand. So don't over-engineer it and over-complicate it. B, show me product that's diversified. So I'm not taking just Ghana SEDI risk or Ghanaian political risk. I can only take 10% exposure anyways, and I'm not getting out of bed for less than $200 million. So show me something that's of scale. And then, of course, wrap it all up nicely and give me an investment grade rating. Doesn't have to be AAA plus, but give me something that I can work with. So this is why we're actually here. We're here to think about how do we use some development capital to really blend in a way that we can create products, we can create transactions that are attractive to this capital that's sitting on the sidelines. So the good part is the money exists. I'm not here to tell you the money doesn't exist. The capital exists. It is in capital markets. It is being deployed. It's just not channeled in the right way. And look at the amount of pension and insurance capital on this continent. I mean, you have in South Africa, PIC is sitting on a lot of money. In Rwanda, we have the Rwanda Social Security Board, you have NSSF, here we have KEPFIC. Where are they putting their money? In government treasuries, commercial real estate, but not really where we want them to put it. So anyways, that's what we're here to talk about. And we're here to think about how do we actually use this structuring approach to create transactions that will be of interest to this group of investors. So I don't have to go through convergence. If you're interested in who we are and what we do, you're more than welcome to come and talk to me. So we'll skip this in the interest of time. We've gone through this, gone through this, gone through this. So yes, so this is actually the crux of blended finance, right? The use of development funding to bring that capital that's sitting on the sidelines into this sector. That's what we're here to talk about. Now, there are three main characteristics that underlie a blended finance transaction. What do you think some of those are? What are some good characteristics of a transaction that we need to make sure that we have in a transaction? I'm sorry?
Auditing your finances for 3 years.
Auditing your financing for 3 years.
Yes.
That's very specific.
So let me ask you one question, just off the topic here. How do we get access to this? I think the major thing that we don't ask is accessibility to the finance.
That's the answer for the next 3 hours. Asking a very, very big question.
Financially viable.
Financially viable. That's the most important. Because by definition, if we're looking to mobilize the private sector, well, they want a return. And they want a commercial return. Right? So return is very, very, very important. Develop an impact. If I am a philanthropy, or if I am a donor, and I'm going to give you my development capital, what am I buying? I'm buying impact. I'm not here to juice your returns. I'm here to buy development impact. That's what I'm in a transaction for. So development impact is really, really important. And it's also important to think about leverage. How many dollars of additional private capital is that $1 of donor money mobilizing? So that's really, really important for all of us to think about as well, because donors or concessional capital providers want value for money, and they want to mobilize. So that's really, really important to think about as well. Now, if you think about financing as a spectrum, aid and philanthropy on one side, commercial investors on the other side, impact and social investors. And by the way, we'll send you this deck, so you don't need to take pictures or squint. We'll share this with you. If you think about financing or funding across a spectrum, all of these different investors have different return expectations. Liquidity requirements is really, really important as well. Some investors need more liquid products. Some investors don't need to be very liquid. Return expectations, impact targets. So what we're trying to do is bring all of these investors into one specific transaction. Very important. I am not trying to get a commercial investor to be an impact investor. I'm not trying to get a donor to be a commercial investor. Everybody is in this transaction to achieve their own impact targets or their own commercial targets. We're not trying to change the characteristics of these kind of investors. What we're trying to do is create a product, create a transaction where we bring all these investors or these funders in, and each of them takes on a risk-return profile that is acceptable to them. So that's really, really important to understand. We're not trying to change behavior here. We're trying to align incentives. I think that's a really important message to communicate. We're trying to align incentives between various different kinds of organizations. And we'll talk more about that. Now, there's two ways to think about blended finance. You can think about blending at a specific point in time. I'm bringing in concessional money, I'm bringing in private money, and I'm blending it at a specific point in time. I'm blending it at the balance sheet level of a specific project. Think of a project finance transaction or a housing transaction, or I'm blending at the level of a specific fund, and the fund in turn is investing across a range of different housing projects, or I'm blending at the level of a fund of funds, and the fund of funds invests in funds that may or may not be blended, and those funds are investing in various different housing projects that may or may not be blended. Do you see what I mean? So you can blend at a fund of funds level, that fund of funds can blend at a fund level, that fund can blend at a project level, but that's blending at a specific point in time. So project, fund, fund of funds level, blending at a specific point in time. But you can also think about blending as something that happens across a continuum. And we spoke about this yesterday on the panel. But if you think about a project life cycle, think about a housing project, right? You need to do technical studies, feasibility studies, land acquisition, look at the regulation, think about import taxes and duties for all of the different building materials that you need, then construction costs, construction cost overrun, construction risk. So think about this life cycle approach to housing, and think about blending across that life cycle. So using grants or project preparation at an early stage, some sort of junior equity or concessional equity at the construction stage, and as you reduce risk over time, and as you move to a more commercial viable transaction, you then take off some of that grant funding or concessional funding and on-ramp some of that more commercially oriented funding. So you can think about blending at a point in time, but you could also think about blending across time, across a time horizon. So there's a couple of different ways to think about blended finance. And you can layer the same thing on with an independent power project, right? Same life cycle approach, same concept to thinking about it. And we can talk about some examples as well a little bit later on.
Quick question.
Yes.
Could you see a scenario where the commercial comes first and the concessional comes later?
Not when it's deployed in a transaction, but you can have a scenario where a commercial is committed, and then that brings in concessional money to unlock that commercial money, but it still has to happen as a life cycle. Do you see what I mean? So when we look at doing housing in Zambia, who's here from Zambia? Zambia. Or I've got many Zimbabwean friends here. When you think about housing in Zimbabwe, or we have some from Mali over here as well, I think, or from Guinea-Bissau, there's many, many challenges, right? We're talking about mobilizing all this institutional capital. You're talking about capital markets in Kenya. The last time I believe we had a IPO in Kenya was, I think, the Kenyan Stock Exchange itself. That gives you an indication of the challenges, right? This is Nairobi. Right? Last time I checked, we don't have capital markets in Banjul or in Mogadishu. So we got a big challenge. So we got capital markets issue. We're talking about all these sophisticated products. We don't even have the infrastructure. Liquidity that's weak. Private investors have limited mandates. So there's many challenges that I'm solving for. We're solving for. We're talking to domestic investors and cross-border investors, and we need both. We need both. We, of course, need to very much think about how do we unlock money that's sitting here from SAMRRA and others, but we also need to think about how we mobilize some cross-border investment as well and mix that together. And we're looking at a range of different challenges, and it's somewhat depressing as well when you look at this. But, as somebody said, we've got essentially a risk-return imbalance here. And when we're looking to mobilize private capital invests along a risk-return continuum, right? What is my return given the commensurate level of risk that you're asking me to take on? So I'm not afraid of risk. I can take on that risk, but I want to be compensated for that risk with a commensurate return. And in the geographies that we all are working with, in the sector that we're working with, there is a massive imbalance. And essentially what we're trying to do with blended finance is we're trying to shift risks or mitigate risks. And there's a slight difference between shifting risks and mitigating risks. Who wants to explain that? What's the difference between shifting risk and mitigating risk?
I could say like shifting risk is just postponing a problem, and the mitigating is solving it once and for all and done with it.
So with shifting risks, I'm also taking the risk from the transaction on myself and I'm putting it onto somebody else, maybe a development funder. Whereas mitigating risk is actually solving for the absolute level of risk. You're right. And or enhancing returns. So shifting risks or mitigating risks and or managing returns. Essentially what we're trying to do is we're trying to bring this into balance so that those investors that are sitting on the sidelines are invested in these transactions. And how do we do this? We do this in a few different ways. So on the shifting risks or mitigating risk side, you could provide project preparation, technical assistance, advisory services, grant-based support. Stuff that we're doing with Althelia Capital, for example, is shifting risks, providing our grant support to your transaction to get it to the point of bankability, creating product. Insurance or guarantees, essentially improving the credit worthiness of a specific transaction. Offtake risk is a big challenge as well over here. So solving for the offtake challenges, or actually taking that capital and investing it in a specific transaction to absorb the first loss, essentially, by saying, if we mobilize commercial investors in the transaction, and they're, let's say on the debt perspective, and their defaults, then we will be the first ones to take that loss, and only after we take that loss does then the losses get distributed to the other more commercially or senior-oriented investors. So that makes an investor more comfortable than they would have been otherwise. Or on the equity side, I could invest in a transaction and say, you know what, if there are equity returns, I'm going to cap my returns, and all the returns over and above a certain cap will be accrued to the more senior investors in a transaction. So there's different ways to essentially shift risks or manage risks. And on the return side, you could provide top-ups, performance-based outcomes, interest rate subsidies. So oftentimes what I've seen in transactions is you got funders that are funding a specific project, and they say, if you achieve, or if you go out and achieve certain level of development impact. So let's say if X amount of houses that you sell are affordable to the most economic weaker section of societies, or there's certain gender metrics that we build in, or certain climate metrics that we build in, instead of paying us back 16%, pay us back 14%. So you're aligning incentives to achieve that development impact and motivating that developer to achieve that impact. So there's different ways to think about it, but essentially what we're trying to do with that limited concessional money that we have is we're looking to shift risks or mitigate risks and or manage returns on the one hand. And we'll talk about some examples as we move on. Palesa, do you want to add anything to any of what I've said so far?
No, I think what's interesting is that as we go through the case studies later, we'll be able to see how this practically has been applied in about three different scenarios. So yeah, this is great.
As you can tell, we're building. So we're slowly moving from concept stage, and we'll get to some examples. How many of you have a finance background in this room? 5.5 people. Well, I know there's more. Some of you are shy. That's okay.
I have a question.
Yes.
There was a slide that had the project life cycle.
I'm sorry?
There was a slide that had
Yes.
the project life cycle, and sort of like how you get to commercial viability, and you see the concessional funding sort of getting out of that entire process. So my question is, what impact does that have on the eventual cost of that capital? Does it mean the blended finance is more for demonstration, and then when they see that this actually works, then the commercial funders can take over?
That's a good question. The way I think about this is blended finance is a means to an end. The end being commercial viability of a transaction, commercial viability of a sector, commercial viability of a specific geography. And so what you're right, this is for demonstration effect. If all of this works on pure commercial terms, we don't need blending. So what we're trying to do is really trying to mitigate as many risks as possible, and a lot of the risks in the life cycle at the early stage. And so as you take off some of those risks, and as you move to as you have demonstration effect and as you move to more commercial viability, you need to take some of that off, concessional capital off the table. That's the idea in theory.
Okay. And then now the eventual cost of that capital, once you've taken out the concessional funding, does it mean that now the risk rating brings down the commercial?
Yes, in theory, right? So let's say we have, sometimes there's actual risk and perceived risk. So if we narrow that gap, then yes, the capital, the cost of capital will reduce.
Okay.
Or if over time, let's say in the housing space in Kenya, if you have better regulation, if you have better policies, if you have examples, if you have successful capital market transactions like Aecon and others, then yes, the next generation of Aecons and others will have a lower cost of capital than the previous one, right? That's the idea in theory. Because think of it from a donor's perspective, right? Think of it from the perspective of a concessional investor or concessional partner or funder. I am looking to demonstrate viability and then move on to solve the next problem. Because as the taxpayer of the government of Canada or Australia or Norway or even countries here itself, you got a very limited amount of concessional money. So we need to solve for specific problems and then move on to the next problem. Right? And so if we can solve for challenges in the housing sector across the continent or the housing sector in a specific geography, then that's what we're looking to achieve. So,
excuse?
Yes.
Yeah, there is this aspect that in most of the projects, there is always the cost of project preparation.
Correct.
And it involves a lot of funding. Who bears that? And that is the biggest issue that is never discussed anywhere. But it has a lot of cost implications. But it's always a dicey, where does it fit? And that is the crux of the matter. Where will you say it's supposed to sit? Because I think that is the biggest problem in Africa, project preparation.
I think I can't stand where I am, but I think you can all hear me. I think one thing we have to realize is it's very difficult to walk away from sponsor equity, or the idea that if you found a piece of land, if you wanting to do a project, there is a certain level of risk that no amount of blending can solve for. That at some point you have to raise enough to be able to show that there's something for us to even talk about. And when we were doing the report, we decided to put in something called stage 0, because stages 1 to 5 will look very familiar to you. And stage 0 was someone needs to sit down and say, I've found this piece of land, I'm looking to do 50 units. Who do I need to speak to in order to make this thing materialize? But there is no way anyone can even open the door to a conversation until you've started doing some of that work. We propose that there should be some kind of grant funding for technical assistance. Technical assistance tends to come in a form that might be a bit too late when it's proposed. And some of the conversations we're trying to have are that even at grant funding or philanthropy, and these are some of the things we're hoping to start opening conversations around, should be looking at technical assistance at that level. Again, grants aren't a bottomless pit. They can't be the crux or the thing that we rely on in order to ignite or catalyze. So the reality becomes that, as with pretty much anything in the real world, you need to go sell a car, sell a second house, do a bit of saving in order to get you that initial, what is this project about and is it something that can actually happen?
And Africa is also a graveyard of project preparation facilities. There's many projects that have got these grants, technical assistance, and then die a slow death soon after. So how do you actually link some of this to equity and debt funding that has viability over a period of time also is an important question. And sometimes, donors, it's just a fragmented space. You have donors that just throw grant money at project preparation, and then that's it. Figure it out, right? And I mentioned this yesterday as well. I'm not, again, expert in the housing sector, but I know from a renewable energy space or infrastructure, whether it's roads, ports, airports, whatever, there are so many technical assistance facilities that all of the development banks, donors, DFIs, even governments, AU, UN, ECA, all of these folks have. The question is, for you as a project developer, you don't know where, like there's no one place to go and see where does all of this sit, right? If you have a relationship at UNECA, you might know there's one pot of money that's sitting here just for Francophone countries or just for the Horn of Africa. And so there are all these little pockets of money, but nobody has mapped out. And this would be interesting from a housing perspective. Maybe, you know, you guys can work on this as a next step to the report is, if I'm a project developer, I want to see who has all of the grant money for technical assistance and project preparation. Who provides guarantees in the space? What kind of guarantees do they provide? Who provides subordinate debt? Who provides viability gap funding? Who provides concessional equity? And where do I what's the entry point? Right? That's the menu we should offer developers, so that a developer in Zambia looks at this on a website and says, okay, now I know where to approach and how to move forward. That I think would be a very, very tangible exercise and helpful for a lot of folks in this room. So, you know, again, when you talk to investors, and the reason I mention this is, I don't think anybody here is an investor. So it's incumbent upon us, if you're smiling there, you're looking to get the money, right? If you're looking to get money, you have to understand how the people on the other side of the table think. And as I said, it's risk and return. That's the only paradigm. And so if I'm an investor, this is the kind of framework that I use in finance, and don't worry about it, it looks complicated. It's called the capital asset pricing model. So I look at risk and I look at return. I'm happy to take on risk, but I need to be compensated for that with a commensurate level of return. And if you look here, it's called a risk-free return, essentially a treasury bond. Minimal risk and a modest return. And that upward sloping blue line is a combination of risk-return criteria that enables me to achieve my fiduciary responsibility. So if I'm on that blue line or upward sloping blue line, I am achieving the interplay between risk and return and achieving my mandate. Well, guess what? In all of the geographies that we work in and in the housing sector, all of the transactions that we come across are on the right-hand side of the blue line. Too high risk and not enough return to compensate for the given level of risk. So essentially, again, this is from my entire presentation, just take this away. Essentially what we're trying to do is we're trying to shift or mitigate those risks. Move from A to B, or move up from A to C, manage those returns. I am trying to get a project from the right-hand side of the blue line onto the blue line, or on the left-hand side of the blue line. That's essentially what we're trying to do and what we're trying to achieve. So that's an important thing for you all to take away from this conversation. I also want to emphasize that blended finance is one of the tools in this toolkit. To some degree, I think I might go out and say blended finance has been oversold. Everyone thinks, oh, this is great, there's a bottomless pit of grant funding or donor funding, and if I just understand this concept, I will be able to make any project that's not bankable, bankable. Blended finance works well when you have a project that's what we call near investable. It's just below the threshold of bankability, and with a little bit of donor funding from technical assistance, from some guarantees, maybe some subordination in the capital structure, we can take a near investable transaction and make it investable. Do you see what I'm trying to say? So if it's just below that acceptable line, we just kind of push it above. But if there's many other systemic risks and challenges, like governance and others, blended finance is not here to solve that. So it is one of the tools in the toolkit. It is not the silver bullet solution for every housing transaction or for every single project. And so it's important to set expectations, because everyone thinks, oh, this is something that will help me solve the challenges that I have in my specific geography or in my specific transaction that I'm working on. And when we talk about examples, I think we'll unpack some of these challenges and risks that we're talking about. So we've got around 10 minutes more for my specific section, and what I want to walk all of you through is, what does that instrument toolkit look like? So now you've understood what is blended finance, what it isn't, when it might work, when it might not work, how do investors think, why are we trying to blend? But now we want to move to the how. And so I'm going to walk you through the next 10 minutes. If you look at the toolbox, if you open up that toolbox of blended finance, what are the various tools that you see? What are the instruments that you see in that toolbox? When does one work versus the other? And then I'll invite Palesa, and Palesa will actually talk about, okay, we've got this toolkit now, but here are some examples that we worked on the continent of Africa, and here are how all these tools have actually been used in practice. So that's what we're going to do for the next couple of hours. And then if we have time, we'll do a group exercise. And we also have a special guest, I believe, Palesa, right? I don't know how special this guest is, but we have a guest. We have a guest. We have a guest, okay. I shouldn't oversell the guest. So there's various different tools in the toolkit, and this is not an exhaustive list, but this is a list of some of those tools. And again, we'll send this to you. I can't imagine it's very visible from the last row, the second to last row. But essentially, you've got a range of different tools. So you can, how many of you heard of viability gap funding? I'm sure one of you at least has heard of viability gap funding. How many of you, yes, you've heard of viability gap funding? Palesa, what is viability gap funding?
I don't know, tell me.
You tell me what's viability gap funding.
Essentially, the viability funding is when I do the pro forma, my revenues do not cover the cost of borrowing. They'll cover, yeah, essentially that's the gap. Yeah.
So let's say you build out a project and you have a certain range of costs, and then you're selling all these houses across a range of different buyers. You're not even breaking even because the cost per unit is X and the selling price per unit is X minus Y, and now you have a gap essentially. And viability gap funding, and I think you can understand what it is, but just by the definition of the name, is somebody coming in and bridging that gap to make your project viable because it's not viable for a variety of different reasons. And we can talk about also why can't you charge the rate that you need to charge to break even. And viability gap funding is something that we've seen and used in housing. It's used in the water sector. It could be used in the hard infrastructure sector, like let's say the rail sector or toll roads and so on and so forth. So essentially the point I'm trying to make is you have your costs, you have what you're able to charge, there is a gap between the two. Oftentimes you have entities that come in and say, okay, you know what, we understand you're not breaking even for a variety of different reasons. We will come in and we will play that bridge between what you need to break even versus what you're able to charge. And you're probably thinking now, is this something that has to happen in perpetuity, or is there an off-ramp? And we can discuss that as well. So viability gap funding, essentially closing the gap, there we go, closing the gap between the economic feasibility and the financial feasibility of a specific transaction. And oftentimes donors just come in and say, here's a whack of cash for viability gap funding to bridge that gap. Have you leveraged viability gap funding in Ontario? You have. Maybe can you just talk about that and give an example? And who provided that viability gap funding? Everyone's like, this is great, but who has that money?
And why were you able to break even? Why weren't you able to sell the units at a level of inventory?
Yeah, so this is actually so I'll respond to your question. The reason, obviously, I'm not able, so I'm from Wood Green. We provide affordable housing for low and moderate income people. So we target rents at about 30% of income in order to stay within the generic affordable housing. So at some point, you can't, it doesn't work, right? The rents that you collect are not enough. So this brings me to the other point. So what are the choices that we have when we get to that point? In some ways, I was saying this yesterday, most of the grant funding, believe it or not, even in places like Canada, have kind of run out. We're living in the same world, right? In that way. So what we have concluded at Wood Green, there's no blended financing without a blended product. So a blended product means that we've had to change our mission so that in our housing portfolio, we have both market rates and we have affordable rates. It's easy to say that, but the implications on the culture of the organization is huge, which for me is probably the biggest part of the conversation. That's my long answer to you.
And the viability gap funding?
Well, from the market, from the new revenue.
Who provided that viability gap? So the market essentially is compensating.
Yeah. So I now have higher paying. I think the same thing you saw in the Indian example. I think they call them HIGs.
Yeah.
So we have to add HIGs into a portfolio.
Oh, the fancy word for that is cross subsidy.
Yes,
I don't like to use the S word, but
that's the word.
But a fancy word for that is cross subsidy. Right, okay, so viability gap funding from the market, but sometimes you also have entities that come in and provide that viability gap funding. How many of you are familiar with the PIDGE group, the Private Infrastructure Development Group? You're familiar with them, so they have viability gap funding as a product. Anybody here from Shelter Afrique? No, nobody here. You just got the logo up, but you didn't show up. Okay. Do you know if Shelter Afrique has viability gap funding? Do they offer? Do you know? Something to find out? Yes, no? You don't?
No, possibly on paper.
Possibly on paper. Okay. Possibly on paper. This is being recorded, by the way. Huh? Be careful. You'll not be invited next year. If registration will be denied. So viability gap funding is one of them. Guarantees. We heard some of this yesterday. What is a guarantee? It's a fancy word. But what is a guarantee?
Transfer of risk.
Transfer of risk. Yeah, this finance man is very fancy. Transfer of risk, yes. Or is it? Let's simplify it for the people who might not know what that even means. Let's say I am a bank, CRDB bank. You are not lending to, this is an example, I'm not saying you're actually doing this. You are not lending to the affordable, you're not lending to a certain section of society because there's collateral challenges, there is challenges around assessing creditworthiness. Maybe you're not lending to developers because of the variety of risks that we spoke about, and so on and so forth. Now, if I want CRDB to change to but what do I want to achieve with that? I want to show you and demonstrate that this is a viable market. Because this time around, I want to give you a 30% guarantee. And the next time around, I want to give you a 10% guarantee. And the next time around, I don't want to give you a guarantee because now you have enough information, enough data to actually make those assessments, whether it comes to lending to borrowers, to lending to developers, or lending to end users as well. Yes, sir.
So just on that. Are you making based on that example, what I gave as an answer, are you making the distinction between a feasibility gap, which you can cover with a guarantee, versus a viability gap, which is actual dollars that you don't have in your pro forma. Are you making that distinction?
Not in this.
Because sometimes the feasibility is subjective. So you can say, because I know that, like in the Indian example, we will lend to women because we know they're going to eventually pay and they're reliable, right? So what you're doing there is demonstrating feasibility.
Exactly. It's more for feasibility. It's more. It's more for closing the gap between the perception of risk and the reality of risk, right? Exactly. The actual. Yeah, exactly. If there's an actual underlying risk, that's a little bit different. We're trying to demonstrate that we know the risk is not as high as it's perceived to be, but you don't have that data to make the assessments, and so we're going to try and make sure that you have the data to make the assessments. And when we talk about the ACON example, you will see a guarantee being used for a capital markets product. Essentially, the private infrastructure development group through an organization or an entity called Garantco coming in and saying, okay, ACON Holdings, you are issuing a bond on the capital markets. We will guarantee investors in that bond so that if there are defaults at the bond level, those investors will be made whole to some extent, and we will take on some of that risk. So you can look to do that in a capital markets instrument to mobilize investors who would not have invested otherwise, or try to change behavior at a financial institution level. Oftentimes the big challenge with guarantees is I've seen organizations and entities run around Africa providing guarantees, and then their mandate changes, and after 3 years or 4 years they disappear, and there is no off-ramp. And the bank goes back to business as usual. The bank's very happy to take on Sweden's AAA rating and others, and then as soon as they leave, they're gone. And so that's the big issue, right? Is how do you have that off-ramp so that now you have the information that you need to make those decisions. So, yes, credit announcement guarantee. That's the example that we're talking about.
I worked on a project.
Yes, please.
On that's a credit enhancement guarantee.
Yes, please, yes.
When you went to number 2, I was wondering, I had a practical example of that case of credit enhancement guarantee. That was in 2009, and to be specific, in Tanzania, on a project I worked on, incremental housing finance. And by that time, incremental housing finance was a very new concept across Africa. So the funder that was providing the credit, because it's a new concept, it wanted the commercial banks in Tanzania then to move in and finance incremental housing because it was a new concept. So it wanted them to leverage for them now to continue propagating this, as you rightly put. When the funder gets out, that's the end of the story. Then it begged the question, as we talk about getting funding from donors, we know it's always time-bound. And I've always got a problem with that. That is always short-term lived, and when you factor in your structuring, then I think you are also not very serious of what you really want to do. You are in for the short haul or long haul. So looking at, there is a whole bit which I talked about, project preparation, which also financial institutions require to be schooled. When you bring some of these ideas to their table, they must be schooled, because we are bringing a foreign idea to them and we want them to run with it. So how do we expect them to embrace it for a long haul? It's not part of their strategy, so there's something we are missing. That's why, to me, project preparation for all the actors becomes a very critical aspect, and we must be intentional about it if we are in for a long haul. Thank you.
No, I agree. You want to respond to that? You're a financial institution. You're shaking your head. You want to respond? Anybody else want to respond to that question, to his comment? Yeah,
just one thing that I found about guarantees is it's double-edged sword. On the one hand, there's adverse risk where you get a credit wrap, but you just don't look at the credit.
Exactly.
You just take a triple A. That's the danger. The flip side, and going back to the Ghana home loans example, is does anybody here from the IFC, before I'm rude? The IFC is not the most speedy institution in the world, I think it's fair to say. Ghana home loans was an example where Standard Bank, FMO, and a few other institutions came in as private equity investors. We started the business. It took the IFC 3 years to become shareholders, even though they'd been in the same process. But the moment that they did, everything changed. because now it was an implicit guarantee. It wasn't even an explicit guarantee. Because you had the IFC involved, suddenly the government of Ghana behaved completely differently. So you had the benefit. It wasn't even a financial benefit. They didn't have to give an explicit guarantee. Just having them there backstopped it. The behavior of government around default management and recoveries changed completely. So
I call that the halo effect.
Yeah, exactly. But it's, you know, I think if you're going to use guarantees, be quite strategic in how you use them, because exactly, there's many unforeseen benefits that are not just financial. Yeah.
No, absolutely. And we can again talk about who these guarantee providers are, because this is a very, very interesting instrument, very useful instrument, but yes, it needs to be used in the right way. So you've got guarantees, you've got viability gap funding, project preparation, technical assistance, but you also got institutions and organizations that actually invest in the capital structure of a specific organization or a specific business or a specific fund. And so that you could provide that on a subordinate level, essentially taking the first loss, or as I gave you the example earlier, you could be an equity investor, you could cap your upside, you could say all of the dividends in the project could go into a specific SPV, and that SPV could then be used to do certain things. So there's various different ways to be creative around how do you essentially be non-market in behavior, right? That's the idea. I'm non-market in my behavior. I'm not taking those dividends out. I'm not looking for equity returns that are over and above a certain hurdle rate that I have for the cost of capital, because I am, again, buying impact, right? So on the equity side, you can be a lot more creative, but on the debt side, it's primarily I am absorbing that first loss. I'm taking on that risk cushion so that others can come alongside me. And essentially, what are we trying to do, right? If I'm an equity investor or a debt investor and I'm subordinate or junior, I am changing that risk-return ratio for those commercial investors. That's essentially what I'm trying to do. I'm trying to change that risk-return ratio for those commercial investors so that they're more comfortable, because we discussed the risk and return piece before, right? That's essentially what I'm trying to do. It's not more complicated than that. And here's how you can do it. One quick example, think about a basic capital structure. Okay, equity and debt. What is more expensive, equity or debt? You can learn, look at this. I'm not going to ask you. What's more expensive, equity or debt? Why?
Well, because the party investing expects a higher rate of return.
But why is it more expensive than debt?
Because it's it takes the risk.
Last in the queue, there's collateral. Equity is all the upside, but all the downside as well. And in case there's defaults across a debt transaction, at least you can have recourse to the collateral and so on and so forth. In equity, there's none of that. So anyways, more expensive than debt. So imagine you have a basic capital structure, 75% debt, 25% equity, or 25% equity. The cost of equity is much higher. You blend this together, what we call in finance a weighted average cost of capital, right? The proportion of equity and debt versus the cost of equity and debt. What is that? What's that number? So in a classic transaction, let's say my weighted average cost of capital is 10.625. That means I need to earn a return over and above that certain threshold to essentially make this, for this project essentially to be commercially viable. If I'm not able to do that, that's when I blend. That's when I bring in grant financing, concessional equity, subordinate debt. I mix it all together, because what I'm trying to do is I'm trying to reduce my weighted average cost of capital to something that's more viable than what it was before. This is just a thought experiment. You don't have to sit and calculate this, but this is just a thought experiment. This is essentially what we're trying to do. We're trying to reduce the weighted average cost of capital of a specific transaction so that the transaction is more viable than what it would have been before. And this is just a mathematical example to make you understand that concept.
I think in a practical housing project, if we look on the left, that equity, that black piece, would literally be your project prep, would be your land acquisition, would be pretty much everything that leads you to a point where you might start putting anything in the ground. And then we get into this debt section, and that subordinated debt piece is likely your bulk infrastructure piece. So this is when you're trying to find the water and electricity and everything else that needs to come to site. Commercial debt is likely to only come in once all those things have been done, because now you've actually got a project. Now this thing looks like it will happen. And that's the only time they come in, and what are they doing? Top structure. And when they do top structure, they're pretty guaranteed that, you know, you either have your pre-sales in check or you have some kind of sense of what rentals are going to be. And you've needed to do pretty much all that work before you get to that commercial debt piece. And once they come in with some level of certainty of outcome. And when it's time to repay, they also want to be repaid first. So as the sales are happening, they want their money in first. It's possibly also something you want to do because you don't want to carry all that debt anyway. So you want to start paying that down as quickly as possible. And then ultimately, because you've been equity in it for the long haul, let's hope there's a nice chunky slug of good money to be made because you were in there right at project prep.
If I can just comment on why I'm so exasperated. I agree with everything you're saying, and I'm very Kenyan-centric. So in Kenya, the commercial banks will only give you, say, 70% of construction cost, right? So your equity to debt is almost 50-50. And the cost of debt is around 15%. And developers are saying their IRRs are now sub 10. So there's no way, as you said, blended is going to fix it. And that's kind of where I'm struggling, that we're just failing. I think Paul said it in his remarks as well. We're failing with just the government failure of lack of infrastructure, lack of this. And that's why I'm just feeling very hopeless, because we run, we run feasibility after feasibility. You get rental yields of 9%, but your debt is 15, your equity should be more. So it just seems like there is no fix. And that's why I think I keep just saying, because I'm almost reaching the end of, if we just do a few projects, we can learn from the projects, bring in the impact investors, because we're not going to get that return, but we've had comments in this room, nobody's willing to do those few projects to actually take it from desktop, where the plans are there, the costing is there, to just build something, see the repayments. I think, I just want to make that comment of, this has been a hard slog of 15 years with no product on the ground. And sorry, I must add that the Acorn is such a special story. We all admire it. But Acorn, like Kenya went through a boom from 2004 to 2012. They built their track record. They built their balance sheet. We can't do that now. We're not in that special place. So it's hard to tell an affordable housing developer who wants to do a quarter acre, 110 units. I mean, our densities are over the roof. We can't over-densify. You can't tell them, do the Acorn story almost, because we need to support these small developers, that massive small, and that's where I still really feel the disconnect. And
it's just also, just to add, it's worth saying without shelter upgrade, there's no income. So how to balance shelter upgrades because there were those institutions that actually invested in the income and they built up their portfolio on that basis.
Yeah, no, it's just slim pickings of good examples in this particular space. We got four, right? Three that we'll talk about. I just wanted to, before I hand over to Palesa, I just want to give you another example of thinking about, and this is from the renewable energy sector. Thinking about how could we use some of what we've seen in other sectors in the housing sector. So if you recall the life cycle approach that I was talking about earlier, from development all the way to refinancing, similar life cycle in the renewable energy space. And so you have a fund manager based in South Africa called Climate Fund Managers that came together and said, okay, we're looking at this life cycle approach for renewables. We're going to design a product or a transaction that peels away this risk across the life cycle. So we're going to set up a development fund first, and this entire development fund is grant funded. So it's $50 million of grants in a development fund that is used to provide renewable energy developers with technical assistance, funding for feasibility, funding for financial modeling, and so on and so forth, legal structure, legal support, all that kind of stuff. Once that transaction is developed, and that moves on to construction phase, and you've got a construction equity basket. 3 tiers. The first tier, the most junior tier, is from donor agencies, donor governments. The middle tier, some impact investors and development finance institutions. And the senior tier is from commercial investors. And again, the weighted average cost of capital with all those 3 is much lower than it would have been otherwise. At the same time, you would not have been able to mobilize those commercial investors if it wasn't for tier 1 and tier 2. So now you've got capital that's going towards construction that would not have gone otherwise. And then once those transactions in the renewable space are actually constructed, they're hooked up to the grid, they are generating some cash flows, then you have the refinancing fund that is purely commercial in orientation, no impact investors, no concessional money in there, and that's refinancing those transactions and sort of you have a virtuous cycle, right? And so once you achieve first close, you pay back the development fund, and then the development fund goes out and supports the next developer. So I just wanted to put this example up here because I wanted to ask all of you, because you're housing experts, could this be something that could be used in the housing space as an example of what we've learned in the renewable space and said, okay, yeah, it might be complicated to pull off. They didn't pull this off overnight. But could you have this approach in the housing space? So Palesa, maybe I'll ask you that question as I hand over to you to walk us through the next examples. We'll get to you as well.
Thanks, Akif. Let me just get myself out of here. That slide. I'm happy to. No, let me take it back to the climate funders. Yeah. I think, good morning to those who walked in after we had started. Thank you for joining us. I think this climate funders example is very pertinent, especially to the last comment made about what it is that is troubling us as a sector on the continent. And maybe we need to start really pinpointing what the real issue is. So in climate funders, what they did was, you know, they raised completely donor because these were, and I think they do it in agri as well, these are projects that were hopeless, projects that, but they knew that if we have that initial capital, we might be able to then keep proving this, so to speak. And these are empty pieces of land, nothing's been done on it. And for these renewable projects, I mean, the technical work that needs to be done and the initial planning is a mammoth task. That was completely grant funded. And as you can see, it was a significant amount of money spent. Now, if this was a housing project and we'd gotten $50 million to just do whatever feasibility required for someone to be able to then start putting the bulk infrastructure in, I think that's the easy part for us as a sector. Now, my question becomes, in that construction equity fund, if we look at our municipalities, if we look at our governments, the regulatory structures, would we be able to, if someone said, here's $800 million, with some level of certainty, be able to install water, electricity, sewer, and put in the kind of infrastructure that money is comfortable with? So i.e., if I'm a bank and I want to put money behind it, I know this is infrastructure that is going to last, I know this is infrastructure that is going to do as it says it will do, and it will be tariffed, so someone has to pay that back, right? So are people going to be able to receive this infrastructure and have it tariffed and paid back? And this is something we struggle with even in South Africa, by the way. You know, are you able to put this bulk infrastructure in and it's going to pay back? It's easy here because what are you building? You're building a solar farm, you're building, wind turbines. Once they're up and they start generating, you've either got a PPA or some other kind of agreement. If not with individual entities, you've got it with the government itself. When you refi that, they're buying pretty much completed projects, you know, and that have had a whole life cycle. By the way, that grant gets paid back, so it's also not bottomless pit. That grant gets to go into more projects. So as we start to kind of contextualize our problem at housing versus in a renewable energy context, I think the multi-layer or the players that come into a housing scenario, you spoke about 50-50 being equity and debt, you know, I have to ask, right at stage 0, right at the beginning, do we have the commitment of our local governments? Do we have the certainty of that infrastructure being available? And when I say available, you're either connecting into it, or, you know, are we still waiting for dams? Are we still waiting for substations? Are we still waiting for a renewable energy project that's going to link into our housing project? And then there's sewer as well, and that's its own little issue. So I think there's some fundamental things that we need to be very honest about that hold back our ability to copy and paste or mimic in other sectors. And unfortunately, the idea that money is available and will just come doesn't work in our sector. In renewables, if we were all renewables people, there'd be maybe quadruple numbers here. The Europeans would be here, the Americans would be here. And I don't want to say that, you know, these are global north issues or, you know, things that are easier for them to do and therefore they participate in. But housing is our problem. And only we can kind of find a way out of it. And to look outwards sounds great, but without a doubt, it's the one thing where I believe only Africans are going to be able to solve for. Clicker. And that's not to say that we can't learn from the ideas that have been put up here. It's to say that when we do try to replicate them, let's really go downstream with those ideas. I'm going to skip through that famous example. I think we've spoken about a few of these archetypes, and we're going to just, let's hope. Okay.
But let's say it doesn't have the balls.
It doesn't have the balls.
You can ask them to put it up and see.
Okay, sure. Maybe let's do that. Let's take a step back. You know, when we started looking at blended finance for affordable housing, my real issue was I was sitting in an investment bank and I was struggling to close transactions at the lower end of the market, i.e. where it mattered most. It was very easy to close transactions where we knew people were high income earners, and the developer would be able to put something up today and in the next few days, you know, he'd be able to sell everything out. So I then approached everyone else within the bank and everyone looked at me very puzzled. And they were thinking, but why? When we can do low-hanging fruit and meet our KPIs and get paid our lovely bonuses, why bother, you know, kind of have that conversation? And then I thought, okay, let me go find friends and family, people who might, you know, hear what I'm saying. I go to the IFC and I find a great ear, and they're like, yes, we've been struggling to really get into the sector. What can we do? We have a conversation, Propaco comes to the party, the EU delegation to South Africa says they're definitely in, and we start structuring and start putting something together. But the hurdle becomes, everyone has different mandates. And as we try to put a structure together, IFC says, oh no, we're keen, but we'll put in money per project. And I said, but guys, no, we said we wanted to pool this because the guys from, we had If You Come In, and they were going to do the equity. And I said, the equity can't make an IRR if you guys get paid back each time and your money keeps coming in and coming out. And then the EU delegation to South Africa was going to give us some grant funding, but they were saying they'll come in only if either KfW or IEB comes in. But the real problem became, the bank also said they're keen to participate, but not in the pool. They want to sit outside the pool, and they only want to do debt again as the projects come in. So it kills the entire model. So I started to ask, why is it that every time we try structure a blended structure, we keep having some kind of roadblock? And why do these structures not see themselves through? i.e., we're able to have many conversations. Everybody loves the sector. Everybody wants to do something in it, but we just can't close. So ultimately, it became that I went out to start speaking to the likes of Convergence and KCAT CAF to say, let's really have a conversation and write a report that starts to question why this isn't possible. And Convergence came back and they said they looked across the market and there were very few blended finance structures in housing. If anything, we couldn't find blended projects. We could maybe find blended funds or funds of funds. So it doesn't really even happen at the project level. The basic or the key takeaways from all of that is the solutions. I mean, Akif asked earlier what you guys are trying to get out of the session this morning, and I heard a lot of things. And sadly, we just don't have the solutions to a lot that you put out. The examples I'm going to show you today are great in that they were able to do it, but as you say, in an acorn scenario, there were a lot of things that had to work for it to work. And I don't think that's unique. I think there's never going to be this panacea. The moments are going to have to come together, and there's going to be a need for some kind of aggression and a real push to want it to happen. Because when you look at these examples, it's because they just refuse to give up. It's because they refuse to be hopeless. You have to have a certain level of wanting it to happen in order for it to happen. Again, I say to what Akif said, the money does sit on the continent, and it's about addressing what others are perceiving as risk, and where risk is real, it's about measuring it, and then obviously finding a way to pay it out. Or wrapping it, as they like to say. I think this would be an interesting one to hear from you, where you think at these various stages, you'll see these stages put in the report, where you think what instrument might be useful at which stage. I'm asking a question. What type of blended instrument would you use at each stage? You could use multiple instruments, by the way, at various stages. I don't know where the other mic is. There's one microphone here. Oh, there's one at the back. There's one there as well. Any guesses, or are you saying there's no blended archetype to use? No, nothing? Must I point at people?
This matrix goes top left to bottom right.
Going that way. So this is how I'll answer the question. So in stage 0, you're likely to find very little except a project preparation grant. And again, maybe it's time we try set out and hunt around so that we can give everyone some kind of template of where these things are sitting. At feasibility or market impact, again, some kind of project prep grant and some kind of technical assistance fund. And then at stage 2, when you're structuring, you're definitely going to look at your concessional debt and equity, concessional guarantee. At fundraising, when you're sequencing, etc., again, concessional debt equity, guarantee, and outcomes-based potentially. And then ultimately at stage 4, once you're looking at execution, discipline, and impact tracking, that's where you're going to come out with your outcome-based, again, potentially. These are not set structures. These are potential recommendations. Your structure, your project will be nuanced and will be unique to your country, your environment. And again, you might have already managed to get some things done yourself, and just pick and choose what you need. Do not take what you don't need. Again, these are just the risks associated with the various areas. I think we've really spoken a lot about how your equity deal sponsor will be responsible primarily for your project prep and equity again for land acquisition. And as you get to bulk infrastructure, you can look at things like mayors from DFIs and whatnot. This is just the wordy table for what I described when Keith put the capital stack up. Macro stability and policy and regulatory environment. I can't emphasize enough that I think that this is where the crux is in terms of where many need to polish up in order for transactions to happen, in order for transactions to be successful. I know there was a roundtable yesterday with the public sector, and I think it's very important that we start really pushing for that stability. If you talk to investment bankers about why they do deals and why they don't do deals, these are some of the first things they look at. We saw things happening to the Naira that made deals very, very, very difficult because guys had contracted rentals at a certain price point, which was paying back debt, and that debt was dollar-based. When you have those fluctuations, it is near impossible for anyone to feel that their money is going to come back. So these macroeconomic elements are huge. And that's not to say I'm giving the DFIs an out. I've always pointed out to them that it's very difficult to come into a South African market wanting to do equity in dollars, and then the next day the rand plummets and then your deal's in the red. But you said you wanted to do a deal in South Africa. Why aren't you doing it in rands? It is almost certain that we are not going to be able to protect your dollar. The DFC in some instances is able to do the hedge as a grant. So they actually do all the foreign currency hedging, but instead of that coming at a cost to the transaction, they find grant money to buy the hedge, which I think goes a long way if someone's going to tell you that they're insisting on using a currency that almost certainly will not be strengthening against yours, or will always be strengthening against yours on the continent. This is one of the case studies in the report. We spoke earlier about tenure. When CRH did this was the 10th bond that they were listing. This was the longest tenure they were able to achieve of 15 years. At 6%. Some of the things, this was Francophone West Africa, so they raised for the entire region. When they were able to do this because when they went to market with this bond, Proparco took up 12% of it. And I know earlier we spoke about halo effects. That halo effect was able to provide the security so that all the other institutional investors could do the rest. Remember I said they did 12%. The local market did the rest. But without that 12%, you couldn't trigger the rest of the market. Something else that was that made it possible is that the strengthening of their balance sheet by the World Bank, and that was also a loan, a concessional one at that. We talk about track record. They have been in the markets doing this and doing it successfully and collecting successfully and not defaulting and not having scenarios where they've given loans that just didn't work. I know it seems impossible when you say it, but it is only with doing, what was it that Paul talks of? Small, massive small, that you get to a point where others start to trust you, others start to give you more. And they had actually tried to do another transaction that had failed simply because it took very long. It had foreign currency stories. There was just a lot in there that made it very difficult. Simplicity is absolutely paramount when trying to do these transactions. We talk about stage 0. if you're sitting there looking at all the DFIs out there, and maybe we're able to provide some kind of list at some point of where these various concessionalities sit, don't try go for all of them. Don't try go speak to everyone. If you're having a conversation with a DFI and you can immediately sense that this is just going to be difficult to achieve, don't go into it thinking that no, we'll solution for it. We'll buy this from this one and then a guarantee from that one and then another. That's 10 years of your time. And acknowledge it early on. Because when we looked at these case studies, when we had these conversations, I mean, some we haven't gone and included in the report, we realized very quickly that legal agreements that had to be done in Washington by very, very large law firms are what got this transaction to 7 years in conversation. French country, English-speaking lawyers, constant translation. I mean, you could see this complication. But nonetheless, these things go ahead only for them 8 years later not to happen. And I know we're desperate. We're desperate to solve for something that needs scale. But if it looks precarious, don't do it. No matter how hard, how much you think it will work, it tends to be what bites you at the end. This is the yeah.
Quick one.
Yeah.
Yeah, I'm looking at your diagram there, and where it's showing that social bond at 6%.
Yes.
How do we get to convince investors to actually go for that bond at 6% in a country where the government, for example, has got government securities that are going at above 6% and so on? And literally somebody who is seeking to make money, who is a commercial investor, literally they're going to look at the numbers.
Yes,
Yeah.
I hear you. I think this again becomes a developmental matter. So when you had Proparco do that first 12%, and then you had the pension funds and institutional investors do it, my sense is that, and I don't know why these particular investors went for it, and I don't know what their government bonds were going at. In most of the countries in the region, this was possibly the most stable. This was possibly the most stable instrument to go into. We know how government bonds are doing on the rest of the continent, and sometimes that's not always the smartest thing to do. The other point here is that there's I say lean on the developmental. When we interviewed the IFC, the first thing they said to us, they said we're developmental in outcome. And that might be the only thing that triggers some of those local investors to participate. What we find when we speak to pension funds more often than not is that they understand that the people contributing to those pensions are government workers who aren't able to access mortgages. So why not invest in something like this where your members are the ultimate beneficiaries, because they then have mortgages that they can afford, and it's at 6%, knowing that the mortgages will be slightly higher as everyone disseminates into the rest of the market. There's no simple answer, but you definitely have to go in fighting, so to speak. This is a tough example, and Lusanda and Catherine are both here, and maybe I should put them on the spot, because when we did this, they're the two that we ran this by. We see a blend here that ultimately benefits the individual, simply because that equity fund in the middle, those entities are all so. Novo is an NPO fund. Those are trusts and pension funds. And then one is a provincial property fund, so to speak. And then one is an NPO itself. As an individual who wants to do inner city, refurbishment of buildings, and as a previously disadvantaged individual in the South African context, there just isn't a product that you can walk into a bank and say, oh, hi, my name is Palesa and I'm really keen on this sector. Could you give me a loan to buy this building and refurbish it and then put it back into the market? So this isn't a story about the broader tough story, which we can get into, but this is a story about how when that individual who could only, let's say put up that first 5% and has markets, maybe slightly above market senior debt for that 80%, needed to find something in the middle. And how that thing in the middle was made possible was finding those individuals or those individual entities. So in this instant, I think it's about saying, how do you support developers by finding a structure internally that is blended? So as you can see, I think Akif put up something around blends happening at different level, at funds of funds, at the project, at a fund, etc. So this is a blend happening for your MES. MES is slightly expensive, but the reality is this individual wasn't going to go find that anywhere else. Lusanda, Catherine, I don't know if you want to add anything. Could you pass the mic?
Yeah, I think you cover it, but I think where it says TAF 21, obviously we put our own money, but in there, there's also significant money from National Treasury, which is
Sorry, Lusanda, go ahead.
No problem. So in there, there's significant money from government, National Treasury, through the Jobs Fund, which is a grant at 0%, of course. So that has enabled us to pass that into Tuko Equity Fund. It's not equity, it's mezzanine. It's a mezzanine loan to help the client with the equity requirement that they have to put in a deal. So we are able to provide this as at less than prime. In fact, up to prime, less 3.5%. While MES is obviously usually more expensive than that, because we were able to blend the 0% grant from National Treasury, which is government, Kagiso Trust, which came at 5%, Novo Impact Fund, which came at about prime less 2%. Yes. So the combination of that meant that the average weight of capital was lower.
Thanks, Lusanda. Is everyone catching this? I feel like everyone's starting to plummet into that mid-morning nap time. Okay, everyone's awake.
Just a quick observation.
Yes.
I think one of the key things that is coming out very strongly, that it's important to have the institutions that are well aligned, mission driven. Then my next question is, in Africa, do we have the right institutions? Maybe we don't have. That needs to come on the table. And we are struggling to twist some that can't be twisted and seem to see this opportunity, because here is about numbers. And if institutions are not wired to do numbers, I think in Africa we have a long way to go. Because all the institutions that we have, they're making money. They have no motivation to go this route. That's my quick observation. And we must be candid about it.
Sorry, there's a hand over here.
Yes, we just, yeah. So the equity fund, doesn't that, if you aggregate all those players, somebody has to manage that, and there's a cost to that. So where's that factored into the whole?
So the institution, TAF, manages all of it. So that's their order of business.
So those are the sort of commercial lenders that lend, the two at the bottom. So we provide financing at up to 80% LTV. So the underwriting of Intutuko happens at a TAF Limited or Umastandi level, where a client would be investing either in an inner city or in a township. So Intutuko is really a zero-cost fund in its own hands, and all the underwriting costs and servicing of the loan and managing the client relationship sits in TAF Pty and Umastandi. The question could be, what's in it for Umastandi and TAF? Is that it enables them to write those deals that they otherwise would not have written, because the clients don't have that 20% equity to put in. So that's how they offset that.
Answered. Just back to the question around institutions and whether existing institutions are meeting us where we need to be met, and maybe it's also a question about whether we're creating institutions anymore, because I think that's where the innovation also needs to happen. We need to be creating more institutions that are like-minded, and maybe it's also about, you know, as we spend the next few days together, about challenging institutions that are already in the space to say, where do you see your mandate being so far away from where the deal actually happens? Because it's all good and well to say that your mandate is X, but if it continues not to meet the deals where they're at, we can talk every year for hours and hours and get very much nowhere. Again, I mean, I know I use the words aggressive, but I think there is maybe a need for that the question starts to be that what in your mandate suggests that a deal can be done? Because your mandate, if you look at it today, find me a deal. Find me a deal that meets this mandate. So I think mandate alignment is also where we're falling. This is IHS Kenya, and what you see up here is possibly the most simplified version of what this transaction looks like. It is a particularly complex transaction. What it tried to do was bring in some euros in an LP, and then it's got some euros in, it's got an LP in shillings, and then the GP obviously is IHS, and then the IFC asked not to sit in the main structure, they asked to sit in a sidecar, and the IFC said, it's called a sidecar simply because it's just, it's connected to the main transaction, but it wants to do its own thing. And in IFC's sidecar, they wanted to be in the sidecar because they wanted to choose which transactions to participate in. So they didn't want to do everything that the GP wanted to do. If I'm using any terms that just seem foreign, please let me know. It's just force of habit. And what the IFC also did is they introduced MAGIC. I don't know if some of you are aware of it. The accelerator program for green construction. It's a grant for H certified, and it comes just as a grant. It's not even linked to the debt or equity that you provide. It is an equity transaction. And what IFC did, what IHS did is, this was long. It took them about 7 years to come to complete close. They had the first financial close with in that Luxembourg partnership with some DFIs in Europe at about $85 million, I think it was. And then they proceeded to raise the balance from IFC, and I think they closed in 2023. With some local investors in the Kenyan shillings LP. The reality is that in order for us to meet scale, it's imperative that we do these kind of structures. You need large quantities of capital coming into our jurisdictions. We need large amounts of capital to be able to do, anywhere near. I think the Kenyan government said they need to be doing 200,000 a year. And we laugh, but I read something just this weekend in the FT where I think the UK government said they need to be doing 100,000 or something. So our politicians have big dreams and things that they think can be done, but we know that practically, just from a supply chain, how do you begin to do 200,000 housing units a year? And even in the most densified, how do you do 200,000 a year? But nonetheless, the point to be made is that to be able to do scale, we need to start having more of these type of structures. And I talk about mandate and where it is. It's not every organization that's going to be built to help small developers. We without a doubt need organizations that are structured to be part of these kind of structures. And if anything, we know that IHS was able to be the off-taker in Mavida's the one we're seeing this afternoon. And I mean, we talk about wanting to help development structures like that. These type of off-takers make a massive, massive dent in the sector. They're able to off-take in the 200s, and that just de-risks it for the developer. If, as a developer, you have significant pipeline, these are the type of structures that are going to make you highly profitable and help you reduce risk. In the IHS context, they are adding, I think Akif spoke about how, sometimes you're handling gender, sometimes you're handling green and what have you. And this green part of it is massive for some of these global north investors. The minute you're saying that, we're going to be delivering EDGE certified homes, not only do you have equity coming out of them, you've also got grants coming out of them, which enhance this transaction quite significantly. Firstly, it pays for the cost of greening, which is what Magic tries to do. Magic says, we've seen a lot of people interested in EDGE, but just can't afford it, and here's a grant. Go ahead and do it. In the South African market, we've seen almost 4 billion rand. We've seen 4 $250 million transactions with the banks that came with about 4% of that as just grant to increase the number of green construction in the housing space. And not only that, Magic also provided a percentage of grant to end users. If you were buying a home that was EDGE certified, a percentage of your home loan was grant. So while complicated, these structures really help concentrate capital into the market. This is going to be my last example, and I think we've got a group exercise. Akif, I don't know how you want to do this because everyone looks like they need a leg stretch.
Maybe we can have Sharif present after you, and then we can wrap up.
So do you want to do the group exercise first?
We might not have time.
How much time do we have?
We've got about 45 minutes, but if Sharif presenting, we might as well go through this slowly.
Okay. I think let's give everyone a leg stretch.
Yeah, and then we can have Sharif present.
And then do Sharif and see how much time we have for group exercise and wrap up. Okay. I'm going to assume you're good masterclass students and can keep time. And could you please be back here in 10 minutes? Just stretch your legs, smoke break, water break, and then come back.
I don't have one up here. Excellent. Oh, are you joking?